What is depreciation? Depreciation refers to the process of allocating the cost of a tangible asset over its useful life. This is crucial for businesses as it affects profitability, taxable income, and asset value on the balance sheet. There are several methods to calculate depreciation. Let's start with the straight line method. This is the simplest and most widely used method, where the asset's cost minus its salvage value is spread evenly across its useful life. For example, if an asset costs $10,000, has a salvage value of $1,000, and a useful life of 9 years, the annual depreciation expense would be $1,000. Next, we have the declining balance method. This method accelerates depreciation, meaning more expense is recognized in the earlier years of an asset's life. To calculate this, multiply the asset's book value at the beginning of the year by a fixed rate. Sum of the year's digits is another accelerated method. Here you add together the digits of the asset's useful life to determine the year's fraction. For a 5-year asset, the sum would be 15, and the first year's fraction would be 5/15. This is particularly useful for assets that quickly lose value. A variation of this is the double declining balance method, where the rate used is double that of the straight line method. This further accelerates depreciation, beneficial for technology firms, where assets like computers lose value rapidly. This method brings higher depreciation in initial years and less over time. Lastly, there's the units of production method. This ties depreciation to an asset's usage, not time. Calculate per unit depreciation by subtracting salvage value from the asset's cost, then divide by total expected production. Multiply this by actual production to find the annual depreciation. In conclusion, understanding these methods helps tailor your business's financial strategy to its needs, aligning asset usage, tax implications, and cash flow.